Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. 2022 was a tough year for investors. There's no way around that. But 2023 might be better. And if we get to a bull market, I think it's important to think about what sort of framework are we going to have as investors and what stocks do we like? So to discuss that, I asked Jon Quast to join me. Here he is, Jon Quast. Thank you for being on the show.
You bet, Travis. Thank you for having me.
Before we get there, I do want to remind you to subscribe to Rive Investing. It really helps out the show, and share this with anybody that would be interested. So let's talk a little bit about 2023. We're going into a year where I think we know a little bit more about what the economic environment, interest rate environment, Fed environment is going to look like than we did a year ago. Remember, a year ago we were, I believe, just starting to see higher interest rates, but inflation was still kind of questionable. There was some green shoots there with inflation, but it wasn't really, really bad. And then throughout the year, interest rates just kept ticking higher and higher and higher. Stocks kept going lower and lower and lower. And it really changed the environment for a lot of us in the market and the way that we think about a lot of companies. So I wanted to give some sort of framework for people to think about with investing. And there are a couple of things that I jotted down that I'm really looking at probably more than any time in the last really 10 years. One, companies that are positive free cash flow. So we've been focusing a lot on growth over the last decade, and that's worked out really well in a lot of ways for investors. But I think a lot of the companies that grew a lot were never actually able to turn that into a profitable free cash flow generating business. One that I was looking up today was Atlassian. You look at, they were actually profitable in 2016, and then they've been losing money ever since. So they've been growing like crazy, but they've been just burning up cash. It's like, is that a great investment today, given that they have not been able to turn any of that revenue growth into profitability? I mean, that's a really tough spot to be in. So I think that's a framing that a lot of companies are in. This is why the market has kind of moved to like old school companies like energy, utilities, because they're valuing cash flow and questioning what those forward-looking projections look like more and more. Another one is, our competitors weakening. I think there's going to be a lot of companies that are either acquired or go out of business over the next 12 to 24 months, not only in public markets, but think about private markets. Think about all the companies that were, VC-backed companies that were funded in the last 2 or 3 years at 100 times sales and just run out of runway. And their founder eventually has to go like, we're either going to fold up shop or we're going to sell to somebody else. Somebody's going to start scooping up those assets. So, a name that I think of is like a Zoom. That's a company that has tons of cash on the balance sheet, would love to expand their moat and the services that they can offer to customers. Maybe they start just acquiring a bunch of really interesting startups. And then, that just goes to, I think, the competitive dynamic generally is something. So if you start with a good free cash flow and you're in a good strategic position, now you start building the next Apple for the next decade. If I bought shares of Apple in 2009 thinking, wow, this is really cheap. Well, there are similar opportunities today. We don't know what they are yet, but we can start building that portfolio. What do you think, Jon? What are you thinking about as your sort of tent poles for going into 2023?
So let me preface what I'm about to say with my prediction for 2023. And so I don't actually see a bull market coming in 2023, particularly not in the first half of the year. Everything that I am seeing is pointing to a still weakening economy. So number one would be housing. So we've seen the biggest pullback here recently in pending home sales that is on record. So we see the home market starting to crumble with the higher interest rates. Interest rates are also having an effect on the used car market. And so I see companies right now with record high inventory, including Carvana, and now all of a sudden consumers can't afford to buy a car because interest rates have gone up and the used car prices are coming down on top of it. So you see this whole collapse potentially coming in the used car space. I think that's going to weigh on the economy. That's huge. You also see jobs, for example. So most recently, the Federal Bank of Philadelphia just revised down the second quarter job numbers. Originally, the estimates were over 1.1 million net new jobs. The revision erased basically all of them. There's only 10,000 net new jobs in the second quarter. So you see this whole jobs market, it's not great. And it actually wasn't even as good as we thought it was. So you see all these things happening. The fourth thing that I see pointing to maybe turbulent market conditions in 2023 is the fact that when you look at the S&P 500, so this is the 500 biggest profitable U.S. companies, when you look at the forward PE ratio, the price to earnings ratio average for the entire market, it is historically high right now at almost 18 times its forward earnings. Now, keep in mind that they have not revised down earnings estimates yet. I think that inflation is still playing a role in earnings. We could see these earnings estimates come down, and so it's even trading at a higher multiple than what would be considered normal on a forward basis. Forward basis would be about 15. That would be about normal for the market average. So all of that sets up where I see the opportunities lie more in the small and mid cap space. So if you look at the valuation here of the S&P 400 mid cap stocks, a much lower forward earnings valuation. Also for the small caps, even a cheaper valuation still on a forward earnings estimate basis. And I think that the numbers really bear this out. So take a stock like PubMatic, for example, symbol PUBM. This has a market capitalization now of under 800 million. And so it's a small cap company. It is profitable, and it is down roughly 20% in the last month on nothing. Absolutely nothing has happened news-wise with PubMatic, and it's down about 20%. And that's after it's already fallen big time in 2022. So we see this continued falling of a small cap stock like PubMatic. Why is that? I think it's end of the year. I think that people are tax loss harvesting, and they're choosing to take their losses on some of these smaller names like PubMatic, and it continues to have that selling pressure on it. I think that goes away in 2023, and we start to see that this is actually an attractive company. Over $100 million of cash on the balance sheet, no debt, in an important emerging industry, which is connected TV. They are winning. And if you look at their supply path optimization, basically what this is they go to a publisher. They're an advertising technology company. They go to a publisher customer and they say, hey, you're working with 20 companies. Let us help you narrow that down to 2 or 3 so that your ad dollars can be more effective. And they are actually then whittling out a bunch of competitors, and they're keeping themselves in the deal. That is happening over and over. A higher percentage of their revenue is now coming from these supply path optimization deals. I think that sets them in an incredible and competitive position. You were just talking about the private sector and how many of those companies might be struggling. I think that PubMatic is probably the most safe of any player in its space because it has so much cash on the balance sheet, no debt, and it is already profitable, and it's cutting itself in on all these deals. I really like this stock here at something like 12 times its trailing earnings.
Yeah, I want to put some numbers to this. $680 million market cap, net income of $44 million over the last year, and free cash flow of $50 million. So this is the kind of company that I was talking about earlier. If your baseline is, look, the business environment may get worse in 2023. But if your baseline is we are profitable today, we can sort of weather this storm and come out of it better in 2024 and 2025. Remember, the market is a forward-looking mechanism. So eventually the market will start looking at, hey, did a bunch of PubMatic's competitors go out of business? Oh, yeah, they did. So therefore, they should be in a much better position from a strategic standpoint, and they got pretty good financials. Wow, maybe this is a growth stock for the next decade. I think that's, you're kind of wrapping up a lot of the things that we were talking about early on in this one company. Maybe one that not a lot of people have heard about. Definitely one that I need to, brush up on because it's not a big name, but it is a valuable space in the market. So I like that one.
Yeah, it definitely is. I think that a lot of what I just said could also apply to a company called Riskified, symbol RSKD. And so this is a company that essentially works with e-commerce companies trying to increase how many transactions get approved, decrease fraud, and it has not done good over this year. It's down about 40% year to date, currently under an $800 million market cap, with 500 million in cash and no debt on the balance sheet. And so this is a company that the market is another small cap company. The market is giving it basically no credit for the business. The enterprise value is about 300 million. And it's a company that is near cash flow break even. I wouldn't say it's profitable on a GAAP basis consistently, but it is near cash flow break even. And, you know, one of their main problems is they do work a lot. One of their biggest customers is Wayfair. Wayfair's sales are down in 2022, so that's definitely weighed down on Riskified stock. Mm-hmm. However, you're not taking a huge risk with investing in a company like Riskified. As they build out their products and services, they've launched, I believe it was 2 new products in 2022 that their existing customers can bolt on. And so you're not paying a whole lot for that kind of optionality. Take a little flyer on a company like Riskified.
I like that one. And those are those kind of small opportunities that could conceivably return multiples over the next decade if you're just willing to buy and hold them. They're higher risk. That's part of the deal if you're buying small cap stocks. But like you said, small caps right now, that is where the opportunity to find value is. I wanted to bring up a couple of companies that I think are really well positioned over the next year, not only to grow just because I think the economy is going to start turning around at some point during the year, but also the China reopening piece. That would be 2 gambling stocks, Wynn Resorts and MGM Resorts. So both of these companies have a sub-concession is what it's called in Macau. If you're not familiar, pre-pandemic, Macau was about 6 times the size of the Las Vegas Strip from a gambling revenue perspective. That effectively went down like 90 or 95% because of China's zero COVID policy. So these companies have had to deal with that for the last 3 years. Operations have kind of been at break even at best over that period of time from a cash flow perspective. Now, remember, this is a business where you spend billions of dollars up front to build a casino, and then the point is that you generate a return over time. But you don't like go out of business if your revenue goes to zero because your operating costs, a lot of your net income includes things like depreciation, which is a non-cash cost. So these companies are fine from a cash perspective. They're not going out of business. But what investors are trying to figure out is when in the world is Macau going to return to any sort of normal? And if you've been following China at all over the last few weeks, you know that the zero COVID policy, it seems like they kind of just pulled the rug on it and they're just letting it rip. That will lead to a lot of chaos, but eventually it will lead to people living more normal lives, traveling outside the country, in and out of places like Macau in a more normal way. And if you think about what happened in Las Vegas, I mean, Las Vegas was shut down for like a month or 2, and people went insane when they finally opened it up again. Today, Las Vegas is generating about 30% more in gambling revenue than it ever has in the past, ever. And so what happens when the Chinese economy opens up and 1 billion people who have been under some sort of, COVID restrictions for 3 years now get to go out and do stuff again? I think Macau is going to have a really good year. It might not be in 2023, but it might be in 2024. We might see that happening already. And that's why these stocks are ones that are the recovery plays that are kind of still interesting to me. Another one would be General Motors. I think this is a company that has dealt with a lot of supply chain issues over the last couple of years. But again, if we have a bull market next year, this is a value stock trading for, I think it's about 6 times earnings right now. It still has the opportunity to grow revenue as they're increasing production. And then let's not forget about Cruise. So they own about 80% of Cruise, the autonomous driving company. Cruise is going to launch their Origin vehicle. We know that they're already testing it. That is a vehicle that's specifically built for robotaxis, basically. It's got 2 doors, kind of opens like a bus. There's no driver in it. They're already testing that in San Francisco. And you can take these cruise vehicles, not just the Origin, but they're kind of retrofitted vehicles throughout most of the San Francisco peninsula now, and they're starting to expand into other cities. I think this is the kind of service that is going to expand a lot quicker than people think. And for General Motors, you basically get that for free. You're getting a value stock, just their manufacturing operations, and then you get this cruise business, this autonomous driving business that could disrupt Uber and Lyft and Tesla, and you get it for free. So I think those are the kind of stocks that are values today. And if we do have a bull market, if the economy does better than investors think, they could just, shoot much, much higher. And so that's kind of where my framework is. I want to get a value today with a lot of upside potential and not a lot of downside risk. So I think that's kind of what's common between all these other stocks. Anything else you wanted to add before we close it up?
Yeah, the final thing that I would add here is that in investing, you should always expect the unexpected. And I know that right now we're talking about how interest rates are only going to continue to go up. And over the next, say, 6 months, for sure, that is going to be true. They've already said that, they're probably going to raise federal interest rates again by another 0.5 basis point at the next meeting, and then probably by 1/4 basis point thereafter. However, we did just note here earlier in our discussion that the second quarter jobs report, they were off by about 1.1 million when it came to jobs. I think that they are working off of potentially some data assumptions that aren't 100% accurate, and that is influencing their decisions. What's going to happen to the interest rates once they start getting more accurate data? Are they going to change course maybe midway through 2023 and actually bring interest rates back down a little bit? Say, you know what, we actually raised this a little bit too much, so we're going to come back down. Maybe not, we're not going back down to 0, but maybe we come back down to 5. What does that do for a company like Upstart? So you look at Upstart here, and a lot of the core tenets of the business are very, very firm. For example, their banking partners, they continue to sign up banking partners, and they continue to retain banking partner customers, credit unions as well. They keep signing new ones over and over again in 2022. What are they struggling with? They're not struggling with people coming to them for loans. That is still more than what they can handle. What they're having problems with is investors funding the loans. And if you think about it, if I have money and I'm funding a loan, why would I fund a loan today at 6% when I can just wait for the Fed to keep raising rates and I can fund it at a higher interest rate later? I'm going to hold off right now and funding those loans. All of a sudden, if the interest rates start coming back down, maybe all of a sudden then you see the funding dollars for Upstart flow back in, because they say, all right, this is the end of that cycle where we were raising rates. All of a sudden, the institutional investors come in, fund Upstart's loans, and all of a sudden, this stock looks very different than it does right now. So that's a little bit more speculation, right? Obviously, because we're still in an environment where rates are going up, and that is not good. We're in an environment where default rates are also coming up. That is also not good. So there's plenty of risk here with Upstart. Mm-hmm. However, what if? This is a what if scenario for 2023 that I don't think is completely unrealistic.
Yeah, and I think that is something that's going to be very interesting to watch. Is if you look at just the inflation data since June, you could make an argument that we're starting to go into a deflationary environment. The Fed definitely doesn't want that, and so that's when you would start lowering interest rates. I've heard some sort of talk about that the market's already starting to look at that. I mean, the one of the 2-year and 3-month spread is negative, which means that investors are projecting that interest rates are going to go down in the future. So there's a lot of things that go on with that. But I do think that the market has sort of turned a corner from worrying about how high the Fed is going to raise interest rates to now considering, okay, what do things look like if where we're at today is sort of the new normal over the next few years? What kind of companies are going to do really well? And it's these companies that can manage their cash flow effectively and have a stable business and not just projecting growth until the end of time. So we will see. But Yeah, I'm bullish on the market. I understand your skepticism of that, but we'll be here covering this throughout the year. So follow Rive Investing here on YouTube and give this video a like. Leave your comments. Let you know what you think about the next year and what you think about these stocks. And we will see you again here next time.